Hello and welcome to the Sovereign Wealth and Pension Funds Dialogue as part of the UNCTAD World Investment Forum. This is going to be a very interesting session for me personally. My name is Simon Mundy. I'm the Moral Money editor at the Financial Times and author of the book Race for Tomorrow. When we look at the ways in which investors and businesses of all sorts can address some of the challenges that we face in terms of global development, the post-pandemic recovery, climate change, and many other issues, sovereign wealth funds and pension funds are in quite a unique position in terms of their scale, in terms of their long-term investment mandate, their ability to invest across a huge range of geographies and asset classes, and their institutional expertise in doing so. There are a few things that we're going to focus on here in particular. One of them is the ways in which these particular sorts of institutions and institutional investors more broadly can contribute to the post-pandemic recovery. Another is focusing on policy and regulation. What can governments do to create the enabling conditions, the conducive environment that will enable these funds to really focus on sustainable investment, maximize their impact from a development point of view? Another point is to do with the interplay and collaboration between investors from developed and developing regions and what they can do together to bring about the badly needed development in developing countries, especially in the context of the need for a low carbon development model. We have a great panel lined up today. We have Mr. Deepak Bagla, who's the Managing Director and CEO of Invest India. Gordon Bajnai is the former Prime Minister of Hungary. He's now a partner and global head of infrastructure and chairman of the Global Advisory Board at Campbell Lutyens. Sabine Dobelli is the CEO of Swiss Sustainable Finance. Angelique Laskewitz is the Executive Director of the Dutch Association of Investors for Sustainable Development. Uche Orji, who I think is hopefully going to join us in a couple of minutes, is the CEO of the Nigeria Sovereign Investment Authority. And Laurent Zilberberg is the chairman of the European Long-Term Investors Association. Before we start the wider discussion, I'm going to hand over to James Zhan, who is the director of UNCTAD's Division on Investment and Enterprise, and who actually initiated the World Investment Forum way back in 2008. James, over to you.
Thank you very much, Simon, for moderating this session. Eminent panelists, ladies and gentlemen, good morning, good afternoon, good evening, wherever you are around the globe. It's a great pleasure to join you for this important conference. It's one of the highlights of the World Investment Forum's 95 events this week. About this event, I think the concerted global effort is needed to increase the SDG investment leading up to 2030, the UN Sustainable Development Goals. And this demands a kind of renewed commitment and a big push for investment and financing along the whole investment chain. So from financial assets owners to companies creating jobs on the ground. The main focus now is on the recovery process from the pandemic. But the issues is not only about reigniting the economy, it is about making the recovery more sustainable and more resilient for future shocks. At the upstream end of the investment chain are asset owners and asset managers, the vast majority of which are institutional investors. The size of the assets managed by institutional investors puts them in a strong position to affect the change on sustainability issues. They can do so primarily through their asset allocation and also through their active ownership. The potential influence of pension funds and sovereign wealth funds on sustainability is enormous. Pension funds and sovereign wealth funds managed global assets of 52 trillion US dollars and the 9 trillion US dollars respectively in 2021. More than 40% of their assets are invested in publicly listed equities, making them the biggest shareholders in companies across the wide range of sectors and markets. Given their long-term obligations, these institutional investors are in a better position to assess long-term risks for their portfolios. And intergenerational nature of their business model tends to make them more responsive to environmental, social, and governance issues, and in sustainable development goal-related issues. So consequently, there has been a realization on the part of these large institutional investors that the ESG factors constitute material risks. Sustainability issues not only represent a material risk for investors, but also a potential systemic risk to the global financial market and ultimately the society at large, as demonstrated by the dire consequences of the COVID-19 pandemic. And this wider systemic risk is of greater concerns to long-term investors who weigh its consequences more acutely. Measuring and rating sustainability performance have therefore become increasingly important and have expanded from company disclosure to emphasis on asset managers and asset owners, such as pension funds. Much of this trend has been voluntary and market-driven, demanded by investors and supported by institutional initiatives. However, public pension funds and sovereign wealth funds could do more to promote sustainability and report on it. According to UNCTAD's report, among the world's top 50 public pension funds and 30 sovereign wealth funds, only 16 public pension funds and 4 sovereign wealth funds published the Sustainable or Responsible Investment Report in 2019. More fundamentally, public pension funds portfolios largely bypass developing countries' market, limiting their contribution to sustainable development there. Developing host countries need to consider reducing entry barriers for institutional investors while safeguarding the public interest. They can use risk-sharing tools such as public-private partnership, investment insurance, and blended financing to help improve the risk-return profile of SDG investment projects and making bankable projects readily available for institutional investors, while taking measures to maximize development benefits. Institutional investors like sovereign wealth fund and pension fund are therefore in a critical, important position, not just to influence the direction of the post-pandemic recovery, but also to support the transformation of capital markets and the products more generally, and to help channel more investment to developing countries and to sustainable development sectors. I look forward to the insights of our speakers on how to better leverage institutional investment for sustainable development in the post-pandemic era. Before I end my remarks, I wish to thank this panel, its eminent panel, for contributing to the work of UNCTAD over the past years. I also wish to thank my team, Ouyang and also Joe Clemens for their relentless efforts to work in this area. Thank you very much. Back to you, Simon.
Thank you so much, James. Some really great points to get us started there. I'd like to go straight in with my first question to the panelists. We were talking in our prior discussion, and James mentioned there about the impact of the pandemic in terms of really shaking up the consensus and status quo when it comes to the economy, when it comes to areas of policy. And so it's really reopened a lot of questions here and created a lot of opportunities for impact, especially by large investors. Gordon, starting with you, in your opinion, this question of how sovereign wealth funds, pension funds in particular, and institutional investors more generally, how they can best contribute to the global post-pandemic recovery? What should be the priorities and the areas of greatest opportunity, in your opinion?
Thank you very much, Simon, and it's a pleasure to be here. So first of all, I believe the global pandemic has not fundamentally changed the key trends, the mega trends, or the trajectory of events, but it has massively accelerated some of those, including the increased need and demand to fight climate change. And in a broader sense, much broader sense, sustainability, or even more broadly, environmental, social, and governance issues. Now, the question is, though, when we talk in the context of institutional investors, sovereign wealth funds, pension funds, and others, insurance companies, what is their role in here? There is an inherent conflict, which is my first point here, between the original mandate of these managers of savings, national savings or pension savings or insurance savings. The ultimate mandate from the outset is to optimize risk-weighted returns for their savers or taxpayers. And when somebody asks these institutions to invest in, for example, sustainability or social development goals, they can argue rightly, my objective is to optimize returns, whatever they are. Can I accept a concession, a reduction in my returns for doing good? And that has been a big issue for quite a few of the largest asset allocators prior to the pandemic. You very often saw small pockets of impact investment where they accepted concession on returns in exchange for social good, but the bulk of the money was still invested in the old way. What has been changing recently, and it changes now at light speed, is that most of these institutions, and I think Director Zhan has reacted to that or referred to that, these institutions are now changing their attitude, and that's the right thing to do. They say sustainability is not a nice luxury on the side in a small pocket. That's an ironclad framework of any investment that we need to do. And then within that framework, we have to optimize risk-weighted returns. That's a very different attitude, because this makes basically all these savings open and available for the sustainability goals. This is now promoted obviously by governments. So if you think about the European regulation, the SFDR, the Sustainable Finance Regulation Directive, or the TCFD, these are regulations and measurements and methods and frameworks that allow these investments to be measured and compared and benchmarked often to each other. So if you can measure it, you can manage it. That is happening now from the government side, and institutional investors are opening all their account of money and make it and force the users of those monies to invest in sustainable goals. So one thing that my point number one is institutional investors should use these frameworks to step up against greenwashing, against non-climate friendly activities. And the other thing, and I think Laurent will make this point probably more eloquently, is to use their long-term attitude, the availability of their money over a long-term planning period, to have a long-term view as opposed to the short-termist optimization of money at the detriment of our long-term objectives. So that's point number one. The second one, somewhat shorter, is don't wait for governments. Yes, the pandemic has accelerated the pre-existing trends that governments play a bigger role than in the previous 30 years in the world. Regulation is more important, strategy is more important, but as an institutional investor, you don't need to wait for governments. Governments will not provide enough opportunities in climate change to invest in. There's a tremendous amount of savings waiting to go into these investment opportunities. There's a tremendous need to use those monies, but it's not the governments who will facilitate all that. So you should talk to the private sector, either specialists who can invest that money in a targeted way, or if you just look at every week how many global corporations or international corporations announce new net zero initiatives or targets, those corporations will need to invest a lot of money at the corporate level without any government intervention, just to do their targets, to reach their targets. So sovereign wealth funds in particular, but all of these institutional investors can help crowd in private sector money next to public money. One example is how a small public guarantee taking first loss risk can crowd in a lot of private money into this sector is a good example of what Europe has done with the Juncker plan in the last couple of years, crowding in 550 billion into European projects. The third point is, I think, around specialization and going beyond classic renewables. When we look at investments in my daily activities, we see that renewable energy, which everybody talks about, is just a small part of what needs investment. There is much more beyond that. There is other forms of energy transition. If you think about going off grid, offering energy as a service, investing in hydrogen, these are all other forms of investments that are not in the classic, boring, middle of the road renewable energy sectors. They offer better returns, and they will accelerate adoption to climate change. The other thing is you should look beyond energy, because there is the electrification of transport and electrification of other parts of our life, which would also be the key to this. And the third thing, the biggest saving is in energy efficiency. We have to find ways with those institutional investors to make energy efficiency investable. And for that, we need regulation, but we also need the private sector and private savings to be invested. I'll stop here with these three main comments.
Thank you so much, Gordon. There's a lot to think about there. Laurent, further to Gordon's point, so are there things that you think we really need to be thinking about here that perhaps people aren't thinking about enough?
Thank you, Simon. Thank you, Gordon, and thank you, Yongfu and James, for the tremendous work you are doing at UNCTAD. It's very, very important. I'm very glad to be here. I chair the LT Association, which is a long-term investors. Broadly, it gathers the national public banks in Europe, and we represent around, let's say, 2 trillion of euros of investment. And we have among our members KfW in Germany, BGK in Poland, Caisse des Dépôts in France, Cassa in Italy, and MFB in Hungary, and therefore we play a role. I would like to be well, in a way, to answer to Gordon and to your question. The first one is the COVID-19 crisis is a tragic opportunity for highlighting the role of national and public financial institutions, along others, for fostering a sustainable recovery. And therefore, I fully agree with what Gordon just said, that it doesn't change totally things, but it accelerates things, and it accelerates the role that we have to play. The second point is what are our common characteristics when we compare sovereign wealth funds, pension funds, and NPBIs, national public banks, and financial institutions. The characteristics are as follows from my point of view. First of all, we have deep pockets. We have a lot, and we manage a huge amount of money. And this means that we are able to survive of the crisis. Second point is we are cautious, because we know that we will have to deal with crisis in the future as we dealt in the past. And therefore we are cautious, and this is why probably all of us have a very important resilient factor after the crisis of 2009, 2008, and of the COVID-19, obviously. And the third thing is that we are all Rolling Stones fans, that we consider that time is on our side. and therefore we see things in the long run. And this is a key point where in a world where we see things going very rapidly. Let's have a look at the three moments of the crisis. The first moment was where the economy was completely stopped. All over the world, probably this is the first time in the history that we stopped voluntarily the economy for an health reason. And at that time, we helped economic actors and more simply our fellow citizens to survive during the first stage of the crisis. For that, what did we do? We managed loans, sometimes grants, on behalf of our governments, interest-free periods, and guarantee, etc. during those incredible times. And to give you one figure, we doubled at LT our commitment from 2019 to 2020. In 1 year, the commitment of the members were doubled. So we play a contra-cyclical role, which is very important at that time. But this was for surviving. Then came the second time of the crisis, is how can we organize the recovery? How could we booster economic actors for giving them the right momentum? And the answer there was diverse. Again, we offered loans, taking the opportunity of current low interest, but this is not enough, and Gordon said it. One of the key issues is not about liquidity. There is a huge amount of liquidity all over the world, and there are also projects. But the issue is about the risks, and also how could we lower the level of the risk to crowd in and attract private investors. And for that, we as NPPI had to change a little bit our model for some of them or enhance for others. We inject equity or quasi-equity in the economy. And this is key for the European countries because we industries globally have a very low level of equity, and therefore European industry was unable to invest, and this explained partly the protectionism all over Europe and all over the world. When you have a low level of equity, you cannot invest, and you need to protect your economy against others. And this is where NPBIs have a key role to play to inject equity. And the third time is also a point that Gordon underlined, is how could we attract the private sector? And we can do it by leveraging, having the leverage effect. And this is the raison d'etre of long-term investment, to attract and to have a global vision. During the first two phases, economic actors logically concentrated or focused their efforts on everything but long-term investment. But long-term investment is shaping our future. And the threat is to use all our resources for keeping alive today's actor, but disallowing tomorrow's to blossom. And for that, and this is the role of long-term investors, is to taking risk at early stage and also to finance the needed infrastructures, not only transport, energy, but also social infrastructures. And by that, I mean education, I mean social, I mean health. And you need all of that to have the keystones of the economic dynamism of the future. And finally, and this is the last point I would like to say, our role is important, but it will be completely futile to consider, not to consider the crisis as an opportunity to direct our economy in the right direction. And the right direction is about a green, sustainable recovery. And our role in the economy is not only to give the fuel for the economy, but to give and to put in the right fuel for the economy. And the right fuel is for a sustainable recovery. Fourth, our funds are equity, loans, or guarantee, but we shall focus on transition projects and on changing the economy for the future.
Thank you so much, Laurent. That's a wonderful contribution. Angelique, I'd like to come to you now. We've touched repeatedly. I think every speaker so far has touched on the things that governments can do in this space. The issue of the environment within which private sector entities are acting. From your point of view, as the executive director of the VBDO, so that's the Association of Investors for Sustainable Development in the Netherlands, what do you think governments can do? Because you have obviously different areas of government activity that, governments can invest themselves using the public balance sheet, governments can impose regulations, governments can give various fiscal incentives. Where do you think governments can be focusing to really encourage the right sort of investment from these sorts of funds?
Thank you, and thank you for the invitation once again. Yes, well, VBDO is an important association in the Netherlands for encouraging sustainable investments, and we target both the investors and the companies. That's first of all. Yes, and I'd like to mention that, well, we are talking about this pandemic, but tested by the pandemic, many of the world's leading institutional investors are demonstrating resilience and agility during the crisis in 2008, the real financial crisis. Many investors deprioritized ESG to focus on solvency. The recovery that followed proved highly carbon intensive, and the coronavirus pandemic represents a visceral reminder to investors and their boards of ESG's role in portfolio management. That's, I think, a different than the crisis before. So ESG will be more integrated into investment processes, and we foresee more proactive engagement and impact investing by institutional investors and governments. The key role of all levels of government and in promoting and implementing sustainable development is clear, including by engaging citizens and stakeholders and providing them with relevant information. Governments are making important commitments to climate change, and for that reason, they should also facilitate investments in renewables and clean energy and infrastructure in developing countries. So development banks and governments should play an important role with regard to funding, and our Dutch government and our development bank, FMO, well, they have several funds, and I'd like to mention the Access to Energy Fund. This is jointly initiated by the Dutch government and FMO to support private sector projects aimed at providing long-term access to energy services in emerging markets and developing countries. And another example, to make it more practical, is a Dutch Fund for Climate and Development. And this government fund allows for investment in projects aimed at climate adaptation and prevention in developing countries. So this could be an example for other countries. And then taxation plays a fundamental role in effectively raising and allocating domestic resources for governments to deliver essential public services and achieve broader development goals. We know that fair and efficient tax systems do not just simply generate resources. Combined with good service delivery and public accountability, they help to build citizens' trust in government and help societies prosper. Tax structures affect society and the economy in many other ways, including through their impact on investment and growth, empowerment of women, sustainability of the environment, for example, the carbon tax, extraction of natural resources, and other themes central to the achievement of the SDGs. And now 130 countries and jurisdictions have joined a new two-pillar plan to reform international taxation rules and ensure that multinational enterprises pay a fair share of tax wherever they operate. So that was my taxation point. And besides this taxation, we must work together if we are to succeed. And international cooperation is key. So no single government can address the global challenges alone, in my opinion. And well, our government promotes sustainability, also in the financial sector, especially at the level of institutional investors, also at company level. So for example, the Dutch pension funds, that's interesting, I think, NGOs, trade unions, and the Dutch government have signed a responsible business conduct agreement on responsible investment by pension funds. And this agreement helps pension funds to gain a clearer picture on the whole institutional investment chain. And so they can tackle, well, issues such as human rights violations and environmental damage. And it's not only for pension funds, to be honest, it's also for insurers and for the whole financial sector in industry. So, and we as VBDO, we stimulate, we have our own ranking system, and that's to assess the sustainable investments of pension funds and insurance companies. So we assess the performance of the institutional investors in the Netherlands regarding, well, the responsible investments, to make clear that you should, that you can invest sustainable. And this is, well, done for several years, for 25 years already. And this is all to create a race to the top. And this is well accepted, and I can, well, I would like to share our system with you. It's a nice system, and it is very important that there is a feeling, and it was said by the first speaker, that it's not, well, against fiduciary duty anymore. So we see strong growth of impact investing on behalf of institutional investors. And we see, well, improvements, of course, space for improvement, but there is a strong growth. So yes, I'm hopeful for the future, and that we make it future-proof, also because we have the EU taxonomy, we have so many rules, and there will be a basis for sustainable investment, especially in Europe, and but also the United States are involved. And well, I mentioned the carbon tax, so it's all focused on well, the climate issue, but also biodiversity is very important. So all these kind of initiatives could be done by other governments. And yes, we should not wait for the governments, but we can work together with governments. That's what I want to add on this issue. Thank you
so much. Thanks so much, Angelique. Deepak, I'm really delighted, as a former Mumbai correspondent, I'm really delighted to see India well represented on this panel. Thank you so much for joining. What's your take on that? Obviously, you know, governments, well, the Indian government has an incredible opportunity here to pursue sustainable development. Could you give your thoughts on the roles that governments can take here to really encourage the right sort of sustainable investment?
Thank you, Simon. And first, I must compliment Yongfu and James to getting us all together. Very timely, very important. And I also must tell you, Simon, that Mumbai has done a great job during one of the most brutal times we've all experienced. You know the density which we've experienced in Mumbai, and yet they've been able to contain this virus. And it's now being looked at as a global example on how well they did it. But coming back to the point which we are discussing today, and let me just start off from where Gordon mentioned, and I think that was a very critical point. It's not just about government, It's not just about investors, it's about all of us together. And this little virus has taught us that there are no choices in that one, but that we all have to get in together. And yes, it has accelerated a big thing. And the biggest thing which I see acceleration is in the mindset. And why I say that that is important, because it is the mindset which sort of takes you forward on adopting and adapting to technology. And when we talk of sustainability, I think that is one very critical aspect sitting within this entire context. But let me again step back and put it in another perspective, that yes, in a country like India, which is moving through its stages of development, the government's role becomes extremely significant. One is the moment you have focus from the government, it sort of brings it out as the big gorilla in the room where everybody has to start looking at it. And that is where you've seen some very defined action points happening in India in this space, especially after Prime Minister Modi mentioned clearly that this is one of the focused areas of the government. And I must add here that out of the G20, India is probably the only one which is on track so far to meet its obligations. Now, coming on to that one, what has been happening within the system? Within the system, either it be a move from the good old fossil to renewable, running the world's largest solar program as we speak, and with over 400 gigawatts is what is being looked at by the end of the decade. We're already close to 200. Or it is trying to see how we can mitigate the risk factors by bringing in controlling, let's say, the auto emission policy, that any vehicle has to be scrapped within 10 years. There's a lot of incentive being given to the electrical vehicle side of it, or the hydrogen part of it. And again, to incentivize all that happening. The other very interesting element which is happening is, and that is where I see a lot of government effort, is startup and innovation. And I alluded to that in my opening remarks, but they are playing a very critical role in bringing frugal, easily implementable solutions where sustainability is concerned. And they are playing a role, especially in a country like India, which is across diversity on any axis which you can think of, economic, social. And the solutions and the answers being brought about by startups and innovators today are the ones which are defining the future course of action, where sustainability is being brought in. And that is where I've seen a very concerted government policy and action has really catalyzed that entire solution providing segment, be it providing them financing, be it helping them get proof of concept projects, be it the government itself investing in their. I'll give you an example, and Simon, you may remember it. There's a big waste to wealth initiative which the government has launched, and Invest India that's one of the things which Invest India is looking. Now, one of the largest land dumps or the garbage dumps in Asia is next to Delhi. And what is happening now is 80% of that dump is being converted into an 8-lane road, which is happening. So this waste to wealth recycling is again a huge means, and especially in an economy which is developing the road to development, this recycling of what is there is a big step towards this entire element of sustainability. Now, let me just step back and from the perspective of when I was hearing Laurent and Gordon and my previous life as a private equity investor. See, from the investment perspective, it's a very challenging time because what we are seeing is both Moore's law and creative destruction at its peak. I remember when we just gone into trying to finance a solar project, we were looking at anywhere between about $1 million to $1.5 million per megawatt. Now that price has come down substantially to just not less than half, but even less than a quarter of that. And in a short period of which had brought in that big investment, within the next 36 months, it's like trying to hold a falling knife. And that becomes where the government can come in to try and insulate the returns, which is happening with, let's say, a long-term purchasing power agreement at those given fixed prices, etc. But those also will become a challenge at some point of time. In the short run, and Lauren, I take you back to your point, in the long run, it's a very challenging investment scenario. We are in a world of transition, we are a world of disruption and rapid disruption, and especially in a country like India. The disruption is unprecedented, both in the pace and the scale at which it is happening. And that is where government policy and action comes in much more significantly. That is where I would like to differentiate the role of a sovereign fund vis-a-vis the role of institutional investors and others. Gordon, I remember, mentioned that institutional investors and LPs will still be governing and looking at it from a return perspective. Now, you may say that it will have a weightage of sustainability, but still return being the primary one. I think sovereign funds will have to take on a new role where they can take on the fact and the position and the focus on sustainability, at times letting go of the returns, at least in the long term, which could get disrupted. And that is a big role which I think sovereign funds will have to fill in. The other encouraging part, which I'm seeing that these days, especially in the past 6 to 8 months, I've had a number of meetings where we are seeing teams come up with pure sustainable funds. And it's not just a carve out of an existing infrastructure fund or something, but a fund which is 100% devoted to sustainability or climate related issues. We're seeing a number of that pools of capital coming in. And hopefully we'll see more of these as far as going forward. So with that, all what I'm trying to bring about is that we are in a very disrupted environment. We are in a very fast transitioning environment, both in terms of technology, both in terms of people's desires and the ability to get things going. And at the same point of time, capital trying to find its way where it can meet the requirements of all those, either the ones who manage it or the ones who own it. And within these disrupting and elements which at times take you to different forces, government comes in as a central role. And one of the examples is that of India, where I think at least in the past 60 months, government policy and role has played a very critical role in us being able to keep ourselves on the path of sustainability and hopefully even as we move out of this virus, be able to do so. Thank you, Simon. Back to you.
Thank you so much, Deepak. Some really, really interesting points there. Uche, coming to you, Nigeria is another country where I've been fortunate to make several reporting trips and really learned a lot about the incredible opportunities for growth there and including for sustainable investment there. I'm really interested to hear your thoughts in your capacity as the CEO of the Nigerian Sovereign Investment Authority of how institutional investors from developed and developing regions can work together to meet this challenge that I think we all want to meet, which is to drive sustainable development in developing countries, including Nigeria.
Sure. Well, thank you very much, Simon. And it's been very interesting listening to everybody else's point of view. But I'll speak from a Nigerian perspective and an African perspective on how we view and define sustainable development. And I think the first thing is there is the focus at the moment on climate change and ESG, which we as Sovereign Wealth Fund have started to focus on in many ways. We've signed up to the One Planet Sovereign Wealth Fund group with certain commitments to making investments in sustainability and making investment to avoid or manage climate change. Our country has made some NDC commitments, and we are tasked in some ways to ensuring that some of those commitments are actually practicalized. Leveraging off of Deepak's last comment, the Nigeria Sovereign Investment Authority is not very typical, and in many ways, I think it speaks to partly to what Deepak was trying to say. Not only do we invest externally, we also make direct investments in our domestic economy. Okay, so 40% of our assets is dedicated to making domestic direct investments in many areas. And 60% is invested in externally through externally managed funds. And then this is global. And within the 40% that's domestic, we have a number of areas of focus from healthcare to agriculture, to roads, to power, to industrialization and to ESG. So this is a new area for us. We've made some commitments there. We've recently signed up a partnership with well, some people might find it a little bit curious, but with an oil trading company to actually invest in ESG in the country in areas like clean cooking, which for us is an incredible area of emission that is really not well recognized. It's easy to talk about fossil fuel, but deforestation, the use of biomass firewood in cooking is a big issue for us in Nigeria, and in many ways linked to deforestation. So being able to invest in clean cooking is one area that we are focusing on at the moment. Not a huge area of return, and this is where I'm going to segue into what I think the international cooperation should be. But let us go back and establish one thing. Climate change is almost like COVID in a way. If we all do not work together, it doesn't matter what the developed economies do. The developing economies will just have the same impact on the environment. Without support, we are all in this together. We're all going to suffer. So, you can turn the entire Europe to clean energy, but if Africa continues to deforest, the net effect will still be very negative for the world, right? If Brazil or Latin America does not do anything about deforestation in the Amazon, you're not going to save the whole world by giving everyone a Tesla car. No, there are other issues that I think we need to recognize, that we are all interconnected. And as a consequence, there must be something done that carries African countries along. Otherwise, it's going to be challenging. To that extent, I believe that direct investments in everything from reforestation, clean cooking, gas flare reduction, resilience, which is something I hear about a lot these days, are all very important in terms of making sure that we all pull together. Now, of course, I've read about, people demanding direct investments of certain sizes. We haven't quantified it. But I think the second thing that needs to be done internationally, I've made this argument in the past, is we must try and encourage African countries to mobilize domestic capital, either by providing first loss equity or providing some sort of guarantee that help them mobilize local capital to invest. Otherwise, like I said, look, the challenge the world is going to face is just the interconnectedness of this, and the fact that if you're not investing in the domestic market in places like Nigeria, then we are all not going to feel the real effect of whatever it is we might be doing at different countries. The third point is I look at all the divestments of fossil fuel by international oil companies and I chuckle. Divestment is not the answer, just shifting it from one bucket to the other, right? The answer is finding a way to sustainably make sure that the economies of these places that depend on fossil fuel are actually in a way reworked. I don't have any specific recommendations here, but I think, when I read Shell or somebody else says, oh, we've solved this, like you just shifted the problem. You haven't solved the problem, right? So it's, and I don't know what the solution is, but I know that this is not the solution. Now, the other point I want to make is that, for many of us, and I think where we're making mistakes as portfolio managers is to check boxes and say, oh yeah, we can invest in this company. They've done this, but we must think holistically about how our portfolios solve these issues. In our organization, we have insisted now on implementing ESG practices across the companies we invest in. We're making direct investments in solar, we're making direct investments in sustainable agriculture, deforestation, land degradation, neutrality, but it's not enough. To answer your question, Simon, what can we all do together? The point is that we all must invest together and recognize that this investment must also be directed in other parts of the world, because it says net zero. I mean, it's not net zero Europe, it's net zero the whole world, right? So I think to that extent, we all need to find a way to pull together. We've recommended in the past the creation of a sovereign guarantee fund that actually helps investors feel the incentive to make this investment. If you're a portfolio manager with targets, you're not going to be making investments and losing money and saying you're saving the world. No, but the world needs to be saved. And so we all need to pull together capital to create that such an incentive structure. I think from the final point I want to make is this. Look, and I just think that, because again, I'm asking your question as to what we can all do together. The final point I want to make is, we talk about transition and just transition. Europe is talked about just transition. We created a fund in Europe to help people get new jobs and all sorts of things. Just transition must be thought about globally. You can't have a situation where certain economies have ruined the planet, and then all those who are trying to industrialize are being told, no, sorry, you can't do anything about it. That's just not fair. That's not just transition, right? Now, we must all sit around the table and decide, how do we fix this? Should we pay a premium for greenhouse gas reduction, carbon emission reduction units out of Africa? That's one way. Reforestation, does it command 5 times, 4 times the premium? How do we rebalance this? Because it's the only way that we must think that way, otherwise we will not be speaking about just transition in a practical manner. So when I listen to a lot of the discussions going on, there's almost an attempt to hide from the real subject. And I think the real subject is the fact that we are all interconnected. And if we don't all pull together to invest in some of these markets, particularly in places like Nigeria, or Gabon, all these other places that truly, really can control and hurt the rest of the world, if not supported, we might all have a challenge. So, a couple of things. One, creating of a global sovereign guarantee fund that helps make investors like BlackRock, anybody else, invest directly in these economies is important. Supporting the countries themselves, and I don't know how that's going to be determined, but it's something that must be discussed. And then finally, co-investing with funds like ours. I love the fact that African countries, particularly my country, has made some modest effort in creating a sovereign investment company. We present ourselves as a co-investment partner of choice, right? So if you really want to address ESG in Nigeria and build solar power in Nigeria, co-invest with us. So these are the things that I think needs to be driven more to a global consciousness in these conversations. And I'm just answering your specific question is, what can we do together as a global financial community? So several countries, I think about 7 now in Africa, maybe 8, have sovereign wealth funds. They're created differently. They're not like the NBIM, which invests externally. We co-invest locally and we invest externally as well. The local investment is largely a co-investment vehicle that encourages and allows the people to invest domestically. So it's just one takeaway is that the financial community must pull together, address this the problem holistically. And I think because if you don't, no one is safe until everybody is safe. And I kind of want to borrow that mantra from COVID, because in many ways, I think this is actually just as interconnected. So that's where I'll stop. Thank you.
Thank you so much, Uche. Some really terrific points there. Sabine, as Uche has pointed out there are some really, really tough questions and challenges here. And developing countries need to develop for the good of developing and developed countries alike. It's important that should be on a low carbon sustainable growth model. And it's not totally clear how that's going to work. What is the role of institutional investors in the developed world, in countries like Switzerland, where you focus, but more broadly in the developed world? What is the role of institutional investors there in helping these countries to face these challenges?
Well, thank you, Simon. And first, I would like to thank for inviting me to this really interesting panel so far. So many things have been said that just really made it resonate with what we see happening here in Switzerland, although, of course, from a very different perspective. The association I represent is maybe not the typical finance association. We try to promote sustainability across all different actors, ranging from asset managers and banks, but also all the way to pension funds. So we also have pension funds as our members. I would say probably similar as with Angelique, with the BDO. And of course, we try to work with pension funds and encourage them to take such aspects into account. But before I really answer your question, Simon, let me frame a bit how we have seen sustainable investments develop here, as we do an annual market study, or have done so for about 4 years now. And I have to say, having worked in this field for quite a long time, I find it quite impressive to see what happened in the past few years. Alone last year, we saw a growth of 31% of sustainable investments managed by Swiss investors, be it asset managers or asset owners, and roughly 1/3 of that was managed by pension funds or insurance companies internally. Now, what does sustainable investment mean in this context? It really means that these investors apply one of the commonly applied sustainable investment approaches, ranging all the way from exclusions to voting and engagement to thematic or even impact investing. So it is a very broad view. But what I found very interesting that in the past 2 years, we saw a clear shift towards approaches that aim for real world outcome of some sort. How can this be achieved? Well, we do speak of typical impact investing in private markets, maybe with a focus on developing and emerging market countries. But on the other hand, we also see a strong shift towards engagement approaches. I think these are two sides of the medal that are both important. On the one hand, we see these institutional investors being a lot more vocal about how companies should behave, not just with regards to climate change, but also generally with their role as to the economic development in other areas of this world where we still need a lot to happen. And for example, on engagement, we saw a plus of 65% in the past year alone. With regards to impact investing, defined in a more narrow sense, the plus was even the highest with plus 70%. That's a broad set of impact investments. Some of them do more have the nature of classical thematic investing, aiming for impact through investments in listed markets, which we all know is difficult, but there's also quite a share in that which refers to private market investments, be it private debt or private equity, with a focus on developing countries. So here we really see a shift from values alignment, risk return improvement now to this third phase of sustainable investing that really aims for a positive change. But the question you posed to both Uche and myself is, how can we cooperate? How can Swiss pension funds and other European pension funds cooperate with Nigerian investors, for example? And I think here it does indeed get a bit complex. And I would like to quote Gordon again, who at the beginning stressed the importance or sort of brought up the view of a lot of the institutional asset owners that it's not their role to do good, but to actually provide a market-based risk return profile with their investments. And I think that the largest job we have in front of us there is really communication. I feel it's a completely underestimated opportunity for large institutional asset owners to expand their emerging market portfolios, their portfolios in private emerging market investments as well. And when we speak to Swiss pension funds and they hear Africa, let's face it, what they immediately say, oh no, Africa is not for us, the risk is too high. And that mindset, we have to change this. I don't know if you see similar things in the Netherlands, Angelique, but that's really the reaction we still receive. And this strikes me, especially, yeah, please.
Yeah, it's true, and it's even not allowed by the regulatory, like the central bank. It's forbidden also to have real strong impact investments on in developing countries. So that's really an issue.
So even more work for the government on this end.
Yes.
But I think, I mean, two things the government can do. The one key thing is make such investments more attractive. And we all know there have to be actions to make them risk return wise equally attractive as other investments, and tools to do that, they have been mentioned before, are concessional debt or equity, are guarantees or risk insurances, even just grants for design or preparation of funds can be useful, or just generally technical assistance grants. We have seen activities from the Swiss government on this. They did the call a few years ago for technical assistance grants that they attributed to different private funds that managed to crowd in pension fund money as well. We now will go a step further in Switzerland and set up a larger platform that allows for the setup of such structures and supports them, be it again through technical assistance or also through other grants, but also guarantees, hopefully. Now, another element is definitely, maybe it hasn't been touched on so far in our discussion, is the question around information. Where do you get the information you need to decide as an investor which investment is sustainable and lives up to the expectations or the targets you set? And here I feel I mean, Angelique, you mentioned the SFDR in Europe. A lot of regulators have been active in trying to make sustainable investments more transparent. But we all know in practice, it's by far not easy to get all this data to really undermine your investment decisions. Here I see a crucial role for digital finance solutions. We just hosted a conference on this 2 weeks ago, where we were able to demonstrate really innovative solutions from many different countries, be it based on spatial data, on natural language processing, artificial intelligence, to just name the other keyword, even based on information such as patent databases. And with such new tools, I think it will also become a lot more easy to actually demonstrate the kind of impact you try to achieve with such investments. But I think one question we haven't answered, both Uche and myself, how do we cooperate on this? And here I feel we just need a lot more dialogue on what can be ways to jointly invest into solutions. And let's face it, I mean, climate change investments are one side of the medal. The other side is just developing an economy and therewith addressing poverty in all countries of this world. So for me, it's also economic development that we need to foster through investments. And there, how do we cooperate? We need probably also cooperation on the level of governments that make such investment vehicles accessible to investors from developed countries in developing countries, but they're co-investing alongside sovereign wealth funds. Local sovereign wealth funds is definitely also an option, and maybe we should go into a bit of a deeper discussion as to how we could move a step forward there, because I do see co-investments when it comes to very specific, often quite small instruments. I don't see the really large chunks moving in these directions yet. But I stop here to maybe leave some time also for an interactive debate.
Thank you so much. I mean, some great points there, particularly to do with the issues of the profit incentive and the impact incentive and how these things can align. It reminds me, yesterday I attended a really interesting breakfast discussion here in London. And a lot of the conversation was around carbon pricing. There was a sense ahead of COP26, and we look at the policy discussions that will happen there. There was a sense that what's really needed, what would really make a difference, is a serious international carbon pricing regime. There's not much hope of seeing significant progress towards that from a lot of people. But there is a feeling that that should be, in an ideal world, what we'd be hoping for. I'd be really interested to hear the thoughts of panelists on that, if it is realistic, and if in that sort of world, what that will mean for these big long-term institutional investors, how that will open new opportunities for them, potentially open new challenges for them. And I also want to talk, building on, in particular, the points that Deepak and Uche made, to do with development. One of the people at the breakfast yesterday was an economist from a developing country who made this point that if developed countries roll out a carbon pricing regime, in order to keep their industry competitive, you'd have to have a carbon border adjustment mechanism, so effectively an import tariff on goods from countries that don't have a similar regime, which could to a large extent be developing countries, which would find that their exports are penalized, their trade and development are held back. And that, for me, I see that as one of the wickedest of wicked problems in the climate change dilemma. So I'd be really interested to hear the inputs of all the panelists on that, and perhaps Uche and Deepak as representatives of developing countries here, which, you know, this is one of the biggest issues that we have in the global debate. Perhaps you could start us off there by unpacking some of those issues. I'm not sure, Uche or Deepak, either of you would like to start.
I was considering Deepak to start, and then I'll join up. Go on, Deepak.
Me first? Okay. See, this is a very big challenge, Simon, and I'm glad you brought this point out. And that's why, if you recollect, what I mentioned in my discussion was transition. Now, what happens in transition is you have an existing set of players which also need to be taken care of. And especially in a system like ours, where there could be a large number of MSMEs or MSMEs to larger players, which do need to be handheld. So the stick and the carrot approach in the transition period, especially where we are in the current context, I think the carrot is a little stronger as a means and a more preferable means to be looking at rather than just the stick. Maybe as we progress to a point where a stick could be used, may be more helpful. But just to say that to penalize countries which are still going through the process of getting their sustainability in place, I think that will set it backward in a multiple factors. And that could impact economic growth, that impacts livelihood. And it's not just livelihood, it's actually lives which get impacted immediately. So, I think every system will take its own time of adaptation and adoption. What has happened with the virus, as we've all said and seen and witnessed, it has been catalyzed. But still, systems will depend upon sizes, etc. And this is a phase where you can nudge them on, but I don't think it is the most appropriate time to use the stick to be able to do that. Thank you.
Thanks so much. Uche, would you like to expand upon that?
Sure. I think I agree with using more of an incentive structure. But also, and I think it's hard to provide a holistic set of recommendations here because this stuff is expensive. And if it is to be done as quickly as we'd like it done, we're talking about a significant level of capital, which some countries today are struggling to provide. We've all just gone through COVID recovery, which has pauperized many more African countries, pushed many more people into poverty. And quite frankly, at the moment, people are thinking survival than thinking about climate change. I mean, whichever way you look at it, we're dead, right? So that's the attitude most countries have taken. So at the moment, and I'll give you an example. We've been working very hard on reduction of use of firewood and fossil fuel. Now, listen, I know some of you might not even imagine what I'm talking about, but yeah, this is the issues that you face. This is not a New York or London issue. This is a Nigerian issue. And then suddenly natural gas prices skyrocket because we've made decisions around, well, the supply chain issues, of course, but we've also made decisions about no more exploration of fossil fuel, right? And so natural gas prices double in 6 months. Cooking gas prices go up. So the few who've managed to convert into using cooking gas instead of firewood have come back to firewood, okay? And so it's a challenge for domestic economies. And what do you say to somebody like that? What do you even say? So we are dealing with some real life challenges here. And for governments to encourage the switch to cleaner cooking methods. And I speak about this because Nigeria is not flickering on industrialization scale. So this is not the issue, but we do two things that we know contribute to significant greenhouse gas emission, and that is lack of clean cooking and gas flaring, which happens with oil companies. Those are the two big areas that I think needs to be tackled. And clean cooking has a knock-on effect on deforestation. So these are all very linked. Some of the things we've talked about is, look, an incentive for African countries is to say, listen, Nigeria, can you commit, or Africa as a whole, can you commit to X quantity of emission reduction? And we'll pay X for it. So people start to see that as kind of rebalanced and leveling up. Tricky to implement, very tricky to implement, but that is one incentive. For an asset manager like the NSIA, we will talk about what we're doing for impact, but representing impact on a balance sheet is a little bit difficult because, people are going to say, yeah, great, the investment is going to turn into nice returns in people's lives, but, you're underperformed your benchmark. And so as an asset manager, you are struggling to ensure that you actually make sure that you keep, and I think to that extent, what gets measured gets managed. There must be a way of quantifying this and representing it in a number through an index that the whole world can relate to. And if you're managing a sovereign wealth fund, the big ones in particular, the countries giving you capital must set those goals and say, look, great, 20% return today, wonderful. But on this metric of sustainability, you've underperformed. And that should be a deductible point, because we are metric-driven people, right? So if you're managing money, it's all about the numbers. And so quantifying some of these development goals will focus the mind in some ways. And if it's through extra capital being given to you, or through taxes, or through whatever else we want to do, and then that then also gets translated to countries, right? Gets translated to companies. At a company level, is there an extra tax for not meeting some goals? Now this is where the stick comes in, right? So it is tricky. Unless we do this, is going to remain, from a company standpoint, a little bit theoretical. It's laughable when, an international company says, oh yeah, I've met my goals, I've just sold the gas fields to Uche, right? And Uche is like nobody, so it doesn't really reflect it. But the rest of the world hasn't really made any change, right? So that's not the metric that saves the world, right? That's not how it works. And so I think that listen, I don't have the answers here, but I know that as a portfolio manager, give me an index to beat, and I'll beat that index, right? That's my goal. And so setting an index that actually captures our feelings and what we want to do, and then have a enforcement methodology, is really the one way to get the rest of the world to play ball. Now, governments should not make the mistake of thinking they can carry this by themselves. It's not possible. It's too big, it's too expensive. Countries at the moment, balance sheets are struggling. So countries really can't afford it now. So the metrics need to be such that we can mobilize private capital. That's where the real money is, right? 2 weeks ago at the One Planet Sovereign Wealth Fund Forum, Secretary John Kerry mentions over $13 trillion, in cash or near cash assets globally, right? That's the real money that you want to mobilize in some ways. And I think getting those metrics set will sharpen the mind, make portfolio managers work to real targets, not targets that shifts the blame around, but also make sure that those who don't meet it get incentivized. And one of those, and I might add, this is self-serving, is how, from our own perspective, co-investing, working with us and addressing some of these issues could also be a metric. So it's not just I'm buying greenhouse gas from Nigeria. If you are, you need to be able to quantify these things have been put back on the balance sheet. Many years ago, when carbon trading started, I thought we're going to go one step further to actually quantifying them in a manner that the whole world can relate to and set a global benchmark around it. That, I think, is a real goal for us that actually mobilizes domestic capital. And of course, this is in addition to my point earlier about creating a guarantee structure that helps people invest. Thank you.
Thanks so much, Uche. Some fabulous points there. Gordon, coming back to you, you've got a great perspective because, of course, you've run a European government. You now have a senior position within the private financial sector, so you can see both sides of that, both sides of the fence in that sense. And there's a debate, as you know, over what is the correct division of labor between the private and public sectors. This point that came up at this private meeting I mentioned in London, to do with, the answer is carbon pricing, but it's never going to happen because governments are too useless and it's not politically realistic. Do you think that's too pessimistic? Do you think that a serious international carbon pricing regime is important? Do you even agree that it's important? Do you think it's realistic? And in the absence of that, do you think there will always be certain limits to what big institutional investors can do?
So from my experience, three things are needed in parallel to achieve a sea change. One is regulation that is happening, for example, in Europe, and I expect that something is going to harden up in the US soon, and New Zealand, Australia, Japan are all moving in that direction, even China. So regulation, that's the government's job. The second one is incentives. The third one is interest. So incentives in the second category would be the financial incentive category would fall carbon pricing or carbon tax to a degree. that would drive behavior probably in the biggest way, but simply by changing the valuation, the pricing of certain assets. And that would be a natural way for governments to create, instead of a hard regulation, just a strong incentive to push behavior. So to answer your question simply, I am for carbon pricing in general. I also think it's as climate change as a whole, a global problem which requires global governance. The problem with carbon pricing, it's very difficult to solve it in individual regions, because they will put them in a competitive disadvantage. And also certain countries will be hugely negatively impacted by a carbon pricing regime. So there has to be some compensation mechanism in that, not to conserve those activities like coal mining, for example, in certain countries, but to allow change and shift and compensate for that. Otherwise, you won't create the political consensus. And then the third thing is interest. So you have to create an environment where it creates returns, good returns, attractive risk return profiles on those investments. That's the interest part, which will also drive behavior. So regulation, incentive, and interest at the same time. Carbon price would also help in this third category, because it would change the risk return equation, and therefore, for example, agriculture sustainably or forestry would suddenly become a much higher returning asset class if you add the carbon credits on top of your normal returns to those activities. Just a simple example. So that's one thing. The other is, I'm very much on board with Uche. So brownfield investment into existing renewables assets, that's not adding directly to climate change. So one thing that many of the institutional investors could do, if they really want to create a positive impact, is to invest more into greenfield, i.e. new projects that are obviously adhering all these climate change goals. Today, greenfield is a relatively small part of investing in infrastructure elsewhere. But by doing a greenfield investment, you create something new that adds to this. Whereas just taking off an existing brownfield is a useful tool, because it allows developers to go back, but it's still a secondary way to contribute.
What could push companies and investors towards that? What incentives could governments put in place to shift the balance towards greenfield?
So there is a huge danger here. If you think about the trillions that the United States currently pondering, or the hundreds of billions that Europe is thinking about, and other countries, India and others, those are big numbers. And I've been in politics, so politicians like to stand up with a big number, and the easiest thing, I gave the money. But the problem is that will create government debt, which ultimately needs to be paid back by taxpayers, and that will slow down growth and will create political problems. Instead, there is all these trillions sitting on private savers' accounts who would love to finance this. So the problem is all this government money, if it's coming from budget, i.e. from debt, that will crowd out the private sector as opposed to crowding it in. So there should be, the governments would be much better off creating, for example, providing, as I mentioned earlier, guarantees or other forms of risk mitigation to allow the private sector to come in, put the private money to use and go forward. And also, just going back to, I think Sabine referring to me said earlier that agreeingly that there is a conflict between doing good and making returns. I just want to be more precise, because this is driving a political behavior. So pension funds are doing good by making returns. Sovereign wealth funds are doing a lot of good by making returns, because that's going back to the pension savers and the taxpayers. So it's their job to achieve positive returns, and that's doing good in one way, helping people to live in pensions, for example. But absolutely agreeing with Sabine, but but then comes this money should be invested in a sustainable way. But very often what we feel, people think when they allow private money to go into, for example, public infrastructure, that they're allowing those sharks, capitalists coming in and creating extra profit on public assets. Well, very often these are not sharks, these are the savers, the pensioners of Geneva, Zurich, or California, investing their savings indirectly into those. So PPP projects for smart governments who know how to run them and how to manage the risk allocation between public and private, well, and put the risk on the private side and let them manage this. PPP projects are a very efficient way to crowd in private money into public goals.
Thank you so much, Gordon. I think I'd like to look a bit deeper at the point that you mentioned and that others have mentioned about the potential alignment or tension between doing good and making returns. And to a certain extent, it comes down to also questions of assessment. Perhaps, Angelique, we could come back to you here. The issue of if you want to do good and make returns, assessing the returns is relatively straightforward. There are very established means of doing financial accounting. Assessing the impact is more difficult. And as you know, there are some who say, look, all this sustainability accounting is a fool's errand, it's quixotic. What we need is carbon pricing, better environmental regulations, make the rules of the game fit for purpose, and then say to the companies, just go and do the Milton Friedman thing and maximize your profit. And it's fine because the rules are such that profit and purpose are aligned by the regulations. Where do you come down in that debate, and how does this affect long-term investors? Because at the moment, those rules are not in place. So how do you work within that?
So many perspectives, so many. First of all, doing good, for me, it means more the philanthropic angle. I think if you talk about the institutional investment side, we just, talk about investing, and then if doing good comes in, I think we all have to deal with the climate change. So we should do something. If it comes to carbon tax, it is an instrument, yes, for sure, because you can't pollute for free. In our opinion, it damages the human being. So doing good would be prevent people from being sick and ill. So that would be So the investment community 15 years ago thought differently, in my opinion. And nowadays it's more and more, a common opinion that climate change is a real risk. And all governments, but all our central banks are in this area of risk. So we should cope with this, and I don't think it's the most difficult topic. We all want this transition, and we all want clean energy, and it will take some time, but we have to get rid of the pollution. So we all want clean air, and what I think there will be a kind of a roadmap. We see on the side of the European reporting that there will be an obligation, it will be mandatory that the TCFD, we all know the rules. We should report on what we pollute. We should also have accountants in this area, and the accountants, the firms are, I don't know, they are not educated that well at the moment, I think, but they will be educated. But there will be assurance on all these numbers, so it will be more or less mainstream, I think, within a decade, and that must be, because we need to speed up. So there are so many angles, so I can't give an answer in short. But I think that because it will be more and more mainstream, that there will be this transition to another form of energy, reduction of energy. Also, of course, another way feed for the food system. We have to come to another. Well, less meat. We can't have the deforestation continue. So I think that we are. Well, within a decade, we are there that there is the financial accounting, but also the pre-financial accounting or non-financial, and it will be merged. So that, I think it's an important topic, and that's an obligation. It's not voluntary. Up till now, it's voluntary, but for the companies and also investors, it is mandatory within short time. So we should not forget this. It's for all people, and especially Europe. So, and then we don't have this idea or feeling that it's just, okay, it's just sustainability and you can do something with sustainability. No, you have to do. So I'm happy with that, to be honest. Yes.
Thank you so much. We are sadly out of time. I think that there's so much more we could discuss, and it's important to continue this discussion however we can. I think the conversation about the alignment of profit and purpose, I think some terrific points were made on that. There is a certain alignment. You can make money from doing things that are good for the planet, but you can also still make a lot of money from doing things that are very bad for the planet. And I think everyone would agree that as long as that remains the case, then we have a big problem. So it's been interesting to hear the perspectives on that. I think we all seem to agree that the question of global climate justice at the global level, I think Uche put this point especially well, that you can't just have countries that, the rich countries have trashed the planet and then turn around to the developing countries and say, well, sorry, you just have to stay where you are because we've made too much of a mess. These are really, really powerful questions. And I think long-term, big institutional investors, sovereign wealth funds, and pension funds have an enormous role to play in using their balance sheets, but also using their clout in other ways. So thank you very much to all our panelists. I personally have found it a really, really interesting discussion. And to all the audience, thank you for listening in, and please enjoy the rest of the conference. Thank you so much.
Thank you.